Hey, I'm getting a lot of questions about whether it's a good time to buy a house. So I think that's always an individual decision. And if you are going to be buying a house, there's a difference between having a plan and then having a strategy about how you're going to make the best deal possible for you. So the first step is understanding the market where you're going to be buying. So one of the things that I like to do is take a look with some tools that I have that we can use in every single county in the United States and decide what's happening in the market. So I'm sitting in the Rochester Hills market, and so I've got that pulled up. We can use this tool to kind of see where the market is, where it's trending, and then I'll take you through a couple other things that I cover with all my home buyers. So this would be specifically, I'm doing a rent versus buy. But we can always put this together if you're looking to potentially move up into a higher price point, growing family, that type of thing. So this basically shows us, it's called the Market Action Index, and it's showing that it is a slight seller's advantage right now. So a lot of people would think that maybe it's a buyer's market. Not really yet, and one of the reasons that this is a 42 right now. It's been pegged at 100 in the past, recently this year, and then in 2021. So that was heavily seller's market. We had 10, 20, 30. I had a client that lost, there were 65 offers on a home. So right now that's not happening. There is an opportunity to negotiate with a seller, and I've got some strategies that you can use to negotiate smartly with your agent when they go to present the offer. But again, let's just kind of take a look at the current market. We've got the Market Action Index, and then one of the reasons, everyone that's talking about housing values crashing, at least here in the Rochester Hills, Oakland County, Michigan area, I'm a bit skeptical about that. And so one of the things that would lead me to be skeptical is, you can see here in December of 2019, 3 years ago, this is pre-COVID, we definitely did not have a good inventory situation, but we had around 300 homes at that point. Currently, we are down in the 160 homes on a 90-day average. So again, we've got about half the inventory. We still have a record number of millennials turning 32, the average home buying year. That's going to be happening for the next few years. So again, if people are saying values are going to crash, here I would be skeptical of that, because one of the other things that we're looking at is the absorption rate, right? So here's what's happening. We're having more homes in Rochester Hills being absorbed, meaning sold, than we are listed. So everyone, all these doomsayers about values coming down significantly, are predicating that on inventory that is not coming to the market here locally. So if we were talking about other markets, that may be the truth, that may be a situation, but it does not seem to be the case. We're selling more absorption rate than are being listed, and so that would not lead to a crash in prices. Going to just kind of show you here, this is somewhere around the median sales price in Rochester Hills, a $535,000 sale, and it's a 2,900 square foot home. This actual listing that I'm picking, they recently had a price reduction of $15,000, and so there are some strategies that you could use to go to the sellers of specific homes rather than asking them to reduce the price, that could maybe be used to improve your payment. And my professional opinion, after 25 years in the business, rates are probably going to go lower. So I've got specific strategies that I would recommend people use around what to do with that sales concession money. And then I want to, again, this was a 2,900 square foot home, so I'm going to also look at a similar home in Rochester Hills. And I would say this home right here is inferior, but it's got a rent amount of $3,400 Again, I would think that the listing that I just showed you would probably rent for significantly more than this, but we're going to just use that number, and then we're going to look at what happens if we've got someone that is looking to rent a single family home versus buy a single family home. And so I used a $3,500 renter's insurance of $63 a month, and then we're using rent increases of 4% annually. Average rent renewals are actually higher than that, but we're going to take this into account for a 10-year analysis. And then again, we're looking at a median priced home of about $550,000, property taxes of $8,500 a year. I think that might be just a little high, but we'll use it for this report. Home insurance of about $160, annual property tax increases of 2%, repairs and HOA fees, let's call that $229 a month. And then at the end of 10 years, if you sell this house, we're going to pay 6% in customary real estate fees. So if you are going to buy this home, you're going to be a little negative on your cash flow versus renting in the beginning. Again, this is just showing a rate on a no-point loan right now. So I do have strategies to make this payment significantly lower. We're looking at rents of $3,500 and a renter's insurance $3,563. And then again, we're in assuming 4% rent increases, which would be something that you can't control, and your rent would be significantly higher at some point in the future based on that. Cash flow difference, because your payment is locked in here at, again, what I think is a rate that's higher than it would be in the future, because you'll have an opportunity potentially to refinance. Your appreciation gain is $263,000, and you gain an amortization because you're paying your loan balance down. Estimated value after 9 years on that house is $813,000 if we are taking into an account a forecasted appreciation rate of 4.5%. And if you're working with me, we're going through these numbers, we can use different variations to be more conservative or more aggressive based on what you think. So you start out with a balance of $440, your mortgage is $383, and your cost to sell, again, in the future would be $48,000. I'm not a tax advisor, but if you're in a 22% tax bracket after 9 years, you may experience $22,000 in tax benefits under the current tax laws. So, in the future, 10 years from now, you would have a net gain of $304,000 if you were to buy a home. So if you'd like strategies to make your offer stand out and negotiate a stronger deal, I highly recommend that you reach out to us. We're going to take you through a process. We're going to make you more like a cash buyer, and we're going to give you the information that you need to make a great decision about buying a home, regardless of where it is in the United States. We can help you all over the country. Any questions, again, please reach out to us, and have a fantastic day. And again, I believe if you're got a long enough time horizon, that now is a great time to buy a home.